So tonight what we're going to be looking at is the swing failure pattern, which I abbreviate to SFP, if you've heard me on Twitter or on the forums. And I did this webinar a year ago, and I'm revisiting it for a couple of reasons. One, because there's more to talk about now. I've been trading it for a year longer, found out a lot more about the pattern, how it works, and how to increase the profitability behind it, and what links the winners, what links the losers. We get a better idea of how to increase our expectancy on the pattern. And the other reason that I really wanted to call this webinar in the first place is because I found a lot of people just go ahead and trade every single swing failure, and you have to be quite picky about the ones that you choose to trade. And we'll look at some examples tonight of why some, as I say, work better than others, and what's going through my head when I'm looking at the pattern itself, what I'm thinking about. Now, let's just familiarize ourselves with what a swing failure pattern actually is, for those of us that are completely new to the pattern. In the market, we have a series of swing highs and swing lows. Now, we have these all over the place. If we look at this is a Bund chart, and I'm just starting out on the Bund. We will look at Forex, equity indices as well. We're starting out on the Bund. It's the market I'm most familiar with, and it's an incredibly good market to trade. On this H1 time frame, we have several swing highs. So we have one over here, and we have one over here, and we have a little one over here, and we have several swing lows in the marketplace. I mean, there's lots of swing points on this particular chart. Okay, now I call a swing high any point at which the market has made a high and the market has moved away from it. So it has swung away from it. So that's a swing high, and then down here we make a low, and afterwards, with hindsight, it's become apparent that that is a low after the market has swung away from it. Now you can get swing highs and swing lows of varying lengths. So let's look at the first one, swing high number 1, and then this one here, which is number 2. What you can see is that the length of swing 1 is deeper than the length of the swing of number 2. So although number 2 is a swing high, it's a short-term swing high versus swing high number 1, which is a slightly longer-term swing high, because price spent longer away from that area and it fell further before it came back to it and broke it. So we have different swing highs of varying lengths on the chart. You can have a bullish swing failure and a bearish swing failure, but let's look at a bearish example because it's a nice one on the charts, and you would just reverse for bullish. So with a bearish swing failure, what we're looking for is a swing high point. So here we have a swing high that formed in the Bunds up here, and that's at 144.80. Now we use that as a frame of reference, and when the market comes back to it, we look and see what the market does at that area. And what we can see here is that the market breaks that area. It actually only breaks it by a tick. Okay, we actually trade up to 81s there, and then the market closes beneath the former high. That is your swing failure pattern. So the market breaks a high and it closes beneath it, and it's a bearish pattern, and we are looking for the market to move down at this point here. Now there's a couple of things to remind ourselves about the swing failure patterns. The bar itself, or the candle, doesn't need to be a particularly bearish candle for it to be a bearish swing failure. This particular candle is, in candlestick terminology, is a doji, which represents indecision in the marketplace. And obviously that's because we get some sellers coming in at the highs, some buyers coming in at the lows, but the market closes the hour out at around the same price that it opened, slightly negative. But it's generally an indecisive candlestick. It doesn't need to be a bearish candlestick up there. All it needs to do is break a former high and close below for it to be a swing failure. And obviously a bullish swing failure would be to break a prior swing low and close above, and we would look for the market to rally. Now the final thing to go over in terms of the pattern and why we actually trade it is because what's happening up here is traders are essentially getting trapped. So if we think about the order flow and we look at what happens in relation to the pattern, as the market breaks a prior swing high, we know that traders that are short the market will have a stop mostly behind swing points. Why do they have a stop behind swing points? Because that's what we're taught in the concept of trend trading, which is that if the trend is downward and the market is weak, then we shouldn't make a new swing high. If we do, we shouldn't be in the trade, and therefore traders put their stops, if they're short, above these previous highs. At the same point, what happens is as the market breaks a high, other traders that are not already in the market become bullish, and again, going back to the trend theory, they are thinking to themselves, this market is making a new high, this is bullish, I'm going to buy. Now, obviously people can hit market up there, but what also happens is if they're not waiting around to actually see the market go through the highs, they will leave resting orders in the marketplace. And if you want to buy above market, you're going to use a buy stop. So whether you're short and you have a stop loss in there to get out for a loss, or whether you are on the sidelines and looking to get long, you're going to have a resting buy stop. And therefore, these areas become what we call liquidity pools for the professionals who know that they need these areas in order to be able to get some decent size onto a trade. Now, I just wanted to explain a little bit about order flow, just for those that want to put a little bit of weight behind this.